Are mutual funds safer than stocks? Come, let's find out through a detailed analysis in this video. Here when I say mutual funds, you would be aware that I am referring to only equity mutual funds. You can ask a question. If equity funds also invest in stocks, then how can you say whether mutual fund is safer than stocks or stocks are safer than mutual fund? Let's understand this through different parameters one by one. Diversification. When you directly invest in stocks, you are investing through your limited means. So the diversification is also limited. But when you are investing through mutual funds, even if it is 5,000 or 10,000, you can invest in one or two funds, which in turn will invest in 50 to 60 stocks in a diversified manner. So if you want to invest in stocks directly with a small amount, investing in 5 to 6 stocks is a huge thing. So mutual funds will help you invest in a diversified manner, and diversification increases the safety quotient. So we can say that mutual funds scores high in the safety quotient. The second thing is research. When we are investing directly, we have to research which stock we are going to invest. We have to go through the sustainability, profitability, whether the stock is in an industry which easily gets distributed, plus quantitative parameters like PE ratio, PB ratio, etc. We have to analyze all of this by ourselves. This is time consuming, and whether we can do a in-depth research is questionable. At the same time, we also cannot research beyond the balance sheet, beyond the analysis report. Whereas a professional mutual fund dealer has a set of people for doing an in-depth research. If they are going to invest in a company, they can also visit it for a verification. If a stock is good, then they will know when to buy it, whether to buy it now or wait and buy it later. Which sector should we invest now and which sector should we come out of? These calls are taken by fund managers. This is their full-time work. We are trying to do this by managing our profession as well. So we cannot do it with the same efficiency. So mutual funds are also stronger than individual investors from a research perspective. Possibility for 100% loss or investment becoming zero. If you invest in stocks, there is a possibility of it becoming zero. Some companies can face total loss and become unlisted. They will also not get traded in the unlisted space. So its value will become zero. Whereas in mutual funds, all our funds are spread and invested in 25 to 40 or 50 stocks. Maybe one or two companies can go to wind up situation or become unlisted. But in mutual funds, this possibility is very less. So there is a 100% loss possibility in direct stocks, no possibility of it in mutual funds. Or we can say far lesser possibility in mutual funds. So when we look at these three perspectives, even though the underlying investments are stock, when we invest through mutual funds, the safety quotient is higher. The fourth is a bonus point. This bonus point is not about safety quotient, but investors should be aware of this. Taxation. If you look at it without digging deep, you will think that both the options carry the same tax. Equity and stock both have short-term capital gain, and if you withdraw before 1 year, there is a 15% tax. If you withdraw after 1 year, in long-term capital gain, there is a 10% tax. Maybe the procedure looks same, but there is a vast difference in its application. For example, from your portfolio, if you directly buy HDFC Bank, but in 6 months, you want to sell it and invest in Kotak Bank. So when you sell it, there is a short-term capital gain tax. Whereas in mutual funds, if your fund manager has HDFC Bank and if he sells it and buys Kotak Bank, you are still existing in the fund. Your fund manager and you don't have to pay any tax for switching from HDFC to Kotak. The tax is only applicable when you as a mutual fund investor come out of the mutual fund scheme. For portfolio churning, you have to pay tax, but when you are doing it through mutual funds, then there is no tax. Next point in taxation is that if the stock that you invest directly and that stock is declaring dividend, you can get the dividend and invest in the same stock or other stock as reinvestment. In this situation, you should add the dividend in your income and pay tax according to the tax slab. On the other hand, if your fund manager has invested in 20 to 30 stocks and all stocks declared dividend, to receive that dividend, your fund manager doesn't have to pay the tax. He will reinvest it and you can see the appreciation in your NAV. You don't have to pay separate tax for dividends in mutual funds. But if you have chosen the dividend option, then it has tax liability. If you are invested in growth option and the underlying stocks declared dividends, your fund manager and you don't have any tax liability. All of that will add in your NAV and you will pay tax only when you withdraw. So from a taxation point of view, mutual funds scores higher than stocks. If you have any doubts on what kind of mutual fund should you choose, then you can take the help of professional financial planner or mutual fund distributor. They will analyze your goals and select the mutual fund schemes that best aligns with your goals. In the same way, they also look at your risk appetite and choose a mutual fund scheme with a similar risk profile. The next is overlap ratio. If there are two funds, they will analyze what are the stocks in those two funds and what is the overlap ratio between them. So if the overlap ratio is less, they will ask you to invest in the other fund. Otherwise, they will advise you to not invest in that fund. The fourth is allocation. In a particular fund, how much should you invest? In an overall equity portfolio, for a particular equity fund, how much allocation should you give? All this can be made clear by a professional mutual fund distributor. So before taking an investment decision, consult a professional mutual fund distributor or a professional financial planner for better clarity. I will meet you with another interesting video. Thank you.
Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.